Friends, in this video for I Thought Wealth, I am going to talk to you on the topic what you need to do now. From my experience, I have observed one simple trend. When the markets are in an extreme bear phase, investors who come in tend to build very decent, healthy portfolios. And then as the markets rise, they start seeing profits. They keep continuing this effort to build a bigger portfolio. They buy newer ideas and they keep on expanding their horizons. Investors explore new themes, new sectors, new stocks, then they explore IPOs and keep being on the lookout for doing something new. It's very important for investors to try out new things. Success in the early phase of investing tends to make us more enthusiastic about trying new things. For us, at that point, it's no more just about making money because we came in, we began at the right time, we bought the right stocks, we made a lot of money. A sense of ownership of good businesses is already inside us. Now we want to have a sense of belonging to the market. We want to be a part of discovery. We want to buy whatever is new, whatever is emerging, whatever is tomorrow's theme. But in the process, what happens is that we get to rely on a lot of external resources. We seek expertise outside and we start following others. When we start following others, we start depending more on them to validate what we want to do. And at some point in time, the quality of our decisions starts slipping. We tend to sell a better business to buy a lesser business. This is something that happens after one great year in the stock market. So if 2020 was a great year, I think this started happening in 2021. Themes which were hyped naturally tend to come to us with more force. The ability to convince an individual is always higher when information hits him with more force. So it's natural for us to be convinced on the themes which are the hottest themes. I must say here that the quality of what information was thrown at us was top notch. There is nothing wrong with the information. But where the problem arises is in the intent. When you bought those great companies in 2020, the frontline stocks, somebody else was buying these undiscovered themes. And then by the time you have come out of those large caps and blue chips to look at these companies, the valuation of these companies have already risen significantly. The emerging themes were trading at a very, very high valuations by the time it comes to everybody. And when it comes to everybody, it is being bombarded at you. It's being thrown at you with great force. Information is coming to you from all quarters. So at some point you think that these new themes are also as good as the themes you bought in 2020. So the themes of 2021, which we thought were great themes, were being equated to the themes of 2020 which were evergreen. Buying a Titan or a Bajaj or a HDFC or a Kotak is much simpler than buying mid-cap and small-cap pharma companies or chemical companies. But we did not see it that way. To us, they all seemed like stocks which cannot be differentiated from one another. If you succeeded in Titan, why can't you succeed in a small chemical company? That is where I think that most people fail to differentiate how decision making can be very demanding when you go down the size and when you buy smaller companies. This is where I think most investment mistakes happen. When I got into the market also, the first stocks I bought were the levers in the ITCs of the world, the HDFCs. Nothing can go wrong. Then in 12 to 18 months, when I was exploring the market, I have gone into newer, smaller things. And typically, that's when the market gives up. You have a scam in 1992. Now you had global liquidity drying up. But something or the other will come to spoil the party. And when the party is spoiled, what you own will not be of the same quality of the stocks that made you money just 1 year before. Today, we are in that place. And it is important for every investor to recognize where we are. If you don't know where you are standing, then how will you go to where you can be safe? So you have to accept where you are. Be objective about what has happened in this 12 to 15 months and then seek answers on what you should do. Ideally, you should try and raise the quality of your portfolio. Now, this is a very generic statement. I may think that buying API companies at this valuation may not raise the quality of your portfolio. Somebody else may say that buying FMCG at any valuation will raise the quality of your portfolio. There could be a third set which would say that buy high quality companies which are being sold by FIIs right now. Maybe that will be a safer way to raise the quality of your portfolio. So each subset of investors will have their own perception of quality. You need to define what is your definition of quality and then stick to that. I would think that if you have entered in 2020 and been hugely successful in the stock market, you can go back and look at what gave you that success. And if you see a lot of quality helping you attain that success, try and match whatever you do now to what worked for you. In every bear market, this is something which I have always tried to practice, and it has taught me a lot of new things about how my own behavior changes and how I need to put it back on track. As market valuations go up, quality of decision making goes down. As market valuation goes down, it's an opportunity to raise the quality of our decision making. We are in a year where we are again going to get that opportunity to raise the quality of your decisions from what it was in 2021. I believe if 2020 was a year of good decision quality, 2022 should recapture that in every individual's portfolio. It's an opportunity. It's also a problem. Solving the problem will open the opportunity for all of us. If you are a new investor who came in, who explored a lot, did many things, enjoyed what you did, but now feel a little uncomfortable, walk out of the discomfort. Don't wait for markets to make things easier for you. Markets will probably make it more difficult. So if you walk out of your zone of discomfort now, you will go and sit in a zone of comfort earlier than others. And when others tend to walk into more discomfort, you will be sitting pretty in a place of comfort. That is something which every investor, both the experienced ones who have seen earlier cycles and for those who are seeing their first cycle, must aspire for. Achieve that place, and then from that place you can move forward. It would be a position of strength for you, and it would help you achieve greater heights going forward. Whether you are going to do index investing, whether you are going to do stock investing, whether you are going to do blue chip investing, whether you are going to do multi-cap or a flexi-cap approach to investing, whether you are going to do thematic investing, whether you are going to do global investing, whatever may be the emphasis of your equity investing, put yourself in a position of comfort, operate in that zone of comfort, ensure there is no discomfort. Once you are there in that zone, you will start investing with far more confidence when the markets appear even more wobbly than we see it today. Preparation is the most underrated aspect of investing. When the markets put us through difficulty, the answer or the solution to that problem is preparation. Now is the time you must prepare, you must move out of your zone of discomfort and prepare yourself, staying in a place or a position of comfort. Thank you for watching this video.